Imagine building a rental portfolio worth hundreds of thousands or even millions of dollars. Now imagine one lawsuit, one tenant dispute, or one unexpected legal issue putting those assets at risk. That's why smart real estate investors don't just focus on buying properties. In this module, we'll cover why legal protection matters, LLCs and ownership structures, asset protection strategies,
Florida property taxes, federal tax benefits for investors, common tax mistakes to avoid. By the end of this lesson,
you'll understand how experienced Florida investors protect both their properties and profits.
Part 1 to 2, why legal protection matters. Every rental property carries risk. Potential risks include tenant injuries, property damage claims, contract disputes, fair housing complaints, contractor lawsuits. Many new investors purchase rental properties in their personal names. That can expose personal assets such as savings accounts, personal residence, vehicles, investments.
One major lawsuit could threaten wealth built over many years. Professional investors use legal structures and insurance to reduce that risk.
Part 2. One of the most popular legal structures for real estate investing is the LLC. LLC stands for Limited Liability Company. Understanding LLCs. An LLC creates a legal separation between you and your investment property. Benefits include structuring your business brings key advantages. You get liability protection and a professional appearance. It also means easier record keeping and flexible taxation. For example, let's look at how it works. If a tenant files a lawsuit against a property owned by an LLC, the claim is generally directed toward the LLC rather than your personal assets. However, liability protection is not absolute. You must operate the LLC correctly and maintain proper business records. Part 3, single LLC versus multiple LLC. Investors often ask, all properties in one LLC? There are two common approaches. Option 1, one LLC for everything advantages. We have simpler management. There are lower annual costs. Enjoy easier bookkeeping. But there is greater exposure if one property faces litigation. Let's consider using separate LLCs. This offers better asset segregation, but difference historikings. But it means more paperwork and fees. As portfolios grow, many investors move toward multiple entity structures. Always consult a qualified attorney and tax professional before choosing an ownership structure. Part 4, as asset protection. An LLC is only one layer of protection. Insurance is equally important. Key policies include landlord insurance, provides coverage for property damage, liability claims, and lost rental income in some situations. Umbrella insurance provides additional protection beyond standard policy limits. Many experienced investors carry umbrella policies because lawsuits can exceed basic coverage limits. Think of insurance as your financial safety net. Part 5, Florida property taxes. Florida has no state income tax, which is one reason investors love the state. However, property taxes are an important ownership expense. Property taxes vary based on county, assessed value, and exemptions. Always estimate property taxes before purchasing a property. Investors should always estimate property taxes before purchasing a property. A deal that looks profitable can become much less attractive if taxes are significantly higher than expected. Always review current tax records during due diligence of rental properties. One reason many wealthy individuals invest in real estate is tax advantages. Some major benefits include interest paid on investment property loans may be deductible. Property taxes are generally deductible business expenses. Operating expense deductions are key. Examples include repairs, maintenance, and advertising, property fees, utilities, and professional services. These reduce taxable income. Part 7, depreciation. Depreciation is one of the most powerful tax advantages in real estate. The IRS allows investors to portion of a property's value over time. This often reduces taxable income even while the property continues generating cash flow. Many investors legally report lower taxable income because of depreciation deductions. This is one reason real estate is often considered a tax-efficient investment. Capital gains and 1031 exchanges. What happens when you sell a property? You may owe capital gains taxes. However, investors often use a 1031 exchange may allow in taxes by reinvesting proceeds into another investment property. Benefits include portfolio growth, tax deferral, increased purchasing power. Because strict rules apply, professional guidance is essential. Part 9, common tax mistakes investors make. Avoid these common tax mistakes. First, poor bookkeeping and mixing finances. Next, missing deductions and tracking mileage. Lastly, ignoring depreciation. Plan ahead. Successful investors maintain accurate records throughout the year. Good bookkeeping saves time, money, and stress. Module summary. Today we learned why legal protection matters, how LLCs help reduce risk, the importance of insurance coverage. Florida, there are deductions available to investors. Consider depreciation and 1031 exchanges. Avoid common tax mistakes. Protecting your assets is just as important as acquiring them. The best investors build wealth while also protecting what they've already earned. Thank you for watching Module 10, and I'll see you in the next lesson.